inflation back to 2%. Right now, we're somewhat below that target. We've had some softer inflation numbers in the last few months, but I think with a strong economy, strong labor market, that we'll achieve our 2% goal on a sustained basis.
I tried to be a gentleman and ask the question indirectly, so I'm going to ask it more directly. Is low inflation something that should be addressed with interest rates?
So first of all, I do think inflation is obviously an important goal for the Fed. We have a dual mandate goals of maximum employment and price stability. We have set a 2% inflation goal, and we need to achieve that on a sustained basis. And so, of course, I do think monetary policy is one of the aspects one of the decisions we need to think about in terms of our inflation goal. And we've been acting in that way pretty consistently. Right now, the inflation data, we were at our 2% goal towards the end of last year. It's come a little softer. I think, when I look at thinking about policy over the next few years, obviously watching how does inflation behave? Is it moving on a sustained basis back to our symmetric 2% goal? That will be one of the factors in thinking about, do we have monetary policy in the right place? Obviously, on the other side of the mandate, watching is the economy evolving in the way that's consistent with maximum employment and a sustainable expansion. Those are factors on both sides of the coin, trying to manage those two goals and get policy right.
John, there's a lot of stuff that's in flux right now. Sometimes it appears over social media at 7:30 in the evening, but I want to put that aside for a second. I want to come back to that. Give us your base case outlook on the economy right now, say for the rest of the year and as much of 2020 as you feel like you can talk about.
Sure. And, one of the funny things is often when I'm introduced, people will read this little canned description of my bio, and it will say that I've spent a lot of time doing research on monetary policy under uncertainty. And if you ever thought that was a good preparation for today, it was. The other question I usually get is, what does monetary policy under certainty look like? And I've never seen it. Let me give you here's where I think things are. Obviously, the economy grew about 3% last year, about 3% the first quarter of this year. So we've been seeing pretty strong economic growth, really strong job growth, unemployment now down to the lowest level in nearly 50 years. So coming into the second quarter, the economy has been on I think, a very strong trajectory, and both in GDP and employment and unemployment. So when I look at the first half of this year, my forecast is GDP growth is still well above what I think of as a trend rate of growth, and expecting unemployment to stay pretty strong. And I expect inflation, to move gradually back up to 2%. So that's kind of in the rearview mirror. Here's the data we've already seen. This is the data we have in hand, which is pretty strong. At the same time, looking ahead, when monetary policy always has to think about where is the economy likely to go over the next year or two, given the lags of monetary policy's effects on the economy. I think there are more uncertainties today. I still think that's my base case is an economy that continues to grow above trend, an economy that still has a very low unemployment rate and inflation moving back to 2%. But, no one has a perfect crystal ball, and there are uncertainties around the global economic outlook, obviously uncertainties around trade and other aspects that could shift the outlook for growth or inflation in different ways. And so from my position as a policymaker, my baseline is a very good one, but at the same time, we obviously, as always, need to be prepared to adjust our views of what's happening in the economy, where the economy is likely to go, and then as a consequence, think about what's the right policy to keep this economy on a good, strong growth path with inflation around 2%.
So since earlier, the first part of May, there's had two new trade issues to deal with. One is this second round of tariffs against China, the threat of the third, and the second one is on Mexico. Tell us how you as a policymaker fold that into your base case scenario.
Sure. And first of all, as you hopefully all know, the Federal Reserve does not make trade policy or fiscal policy of those. We make monetary policy, so we have to try to take those developments into account in our thinking about the economic outlook. And we have a lot of economists who've studied this pretty carefully. So, I think that a few things that come right to mind. One is the trade clearly does affect the flows of exports and imports. We're seeing some of that. Research from economists has shown that higher tariffs does show up in terms of higher consumer prices and producer prices in the U.S., and that's boosting inflation a little bit and drag on growth on some dimensions. I would probably broaden this to more to talk about what we're hearing from business people, though. If you look at the Beige Book, if you were to attend the meetings I and my colleagues have with business and other leaders in communities across the country, this is very much on people's minds. People are concerned about how do they plan for the future, the uncertainty about what happens around trade, and when business and other leaders are uncertain about things, the tendency is to take a wait-and-see attitude and maybe hold off on some investment or some employment decisions to see how this clarifies. So we're definitely seeing signs, I think mostly anecdotal, about businesses concerned about wanting to see how this gets clarified before they're willing to kind of invest. We're also seeing investment data itself coming in a bit softer than we had seen last year. So I think those are signs that it's clearly having an effect on the economy, slowing growth somewhat. And I think this uncertainty part is an important part of it.